Hello everyone, let's start our today's discussion. I hope you all remember that in our previous class we had discussion on topics of dividend income and trust income in chapter of basic income tax calculation. In our today's class we will be moving forward and we will be looking at the issues relating to interest in possession trust. But before going in detail of our today's class, let's take a quick review of what we have discussed till now in our discussion of basic income tax calculation chapter. We started this chapter with a basic format of the income tax return of individuals. UK residents have to divide their incomes earned during a tax year in three heads. The first head was non-saving income, second was saving income, and third one was dividend income. Non-saving income includes all the normal incomes except interest income and dividend income because they have their own heads. Interest income is classified as saving income and dividend income is classified under its own head of dividend income. Non-saving, saving and dividend. These are the three heads of taxation and they have their own tax rates. We looked at the basic format of the tax return in our first class of this chapter. Then we looked at the personal allowance, the taxable income, and the tax bands, basic rate band, higher rate band, and additional rate band. Then we looked at the tax year, which is being followed in UK, which starts from 6th of April and ends on 5th April. Then we applied these concepts in three practice questions, which we did in the first class. Then we introduced the concept of real estate investment trust, which was a mutual fund, raise this investment from the public, and then invest in the real estate market. Now, the investors who are getting the dividends from the real estate investment trust, it is taxed as non-saving income, 20% withholding tax, and it's taxed on receipt basis. Normally, dividends are taxed under its own head, but the dividend from a real estate investment trust is taxed as a non-saving income because it is earned from the property market and property income is classified under non-saving income. We discussed all of these issues in our first class of this chapter. Then in the previous class, we introduced the concept of dividend income. We looked at its tax rates. We looked at the 0% band of the dividend income. We applied that in three practice questions. And then we introduced the concept of trust income. We looked at the concept of trust, that trust is a separate entity, a separate body in which the donor is giving the assets. Those assets are managed by the trustees and the benefit is being given to the beneficiaries. We looked at the reasons of creating trust. We want to give income to those who cannot manage it, like small children or some old age people or any social entity which cannot manage that source of income itself. So that's why we appoint a board of trustees to manage it. We looked at all of these reasons in detail in the previous class. Income is to be given in a systematic manner. Income tax planning to distribute income among a lot of beneficiaries so that you can take the benefit of personal allowances and basic rate band and the inheritance tax planning involved in it. We then looked at the concept of discretionary trust, which operates according to the decision of the trustees. They can take all decisions like changing the beneficiary, adding new beneficiaries, removing the beneficiaries, closing the trust, changing the activity. So I highlighted that the primary reason of creating discretionary trust is not to give income to those who cannot manage it, because the trustee can change everyone. It is created purely for income tax planning purpose, where a trustee do income tax planning by changing the beneficiaries. And we never give control of our assets to any unknown person. Normally, in discretionary trust, the donor himself becomes the trustee or makes his family members as trustees. The objective here is to do income tax planning. It's taxed on receipt basis, assessed under non-saving income, and withholding tax is 45%. We applied these concepts in two practice questions. I hope you all remember. Now, in our today's class, our main topic is interest in possession trust. But before going towards that, let's do one practice question in which there is discussion of discretionary trust. With this practice question, you will get a revision of what we have studied in the previous class. Then we will talk about interest in possession trust, and we will be doing three questions in relation to interest in possession also. But let's first revise the previous class through this practice question. Mr. Z has following incomes for the year. Property income 16,500. Income received from discretionary trust 8,000. Now, on discretionary trust, you all know that there is withholding tax of 45%. And then a normal dividend income of 7,000, we have to do the tax payable. I believe you all remember the previous class. So let's look at the income tax return. I want you all to listen to me carefully. Income tax return. One head of income is non-saving and the other head is dividend. Okay. So these are the heads of income, non-saving and dividend. Okay. Now comes the property income, 16,500. Property income goes under the non-saving head. Discretionary trust, it's 8,000 divided by 55% because 45% is the withhold multiplied by 100%. Okay, so let's do it. 8,000 divided by 55% multiplied by 100%. So it's 14545 because 45% is the withhold. And then comes the dividend income, that's 7,000. Dividend goes under the head of dividend income, obviously. So now the incomes are classified. You can arrive at the value of total income. So what is your total income? 16,500 plus 14545. Okay, so that gives us 31045 and the dividend is 7,000. You will deduct your personal allowance, that's 12570. You will deduct your personal allowance 12570. That gives you your taxable income. Okay, so what is your taxable income? Taxable income 12570. So it's 18475 and here it is 7,000. I believe it's just routine. Property income goes in non-saving discretionary trust. You gross it up. 45% is the withhold. Then the dividend goes under the head of dividend. You deduct the personal allowance, you arrive at the taxable income. Let's charge tax on it. Now your non-saving income is 18475 till 37,700. It's your basic rate band. So 18475 multiplied by 20%, that gives you 3695. Then comes the dividend income, which is 7,000. On first 500, it will be 0% tax. On first 500, you always charge 0% tax, so that gives you 0. Now, obviously, the basic rate band won't end. The basic rate band is still 37,700. So the remaining 6,500 will be going in the basic rate band at 8.75%. So that gives us 8.75%. So that's 569. You'll get your tax liability. So your tax liability will be 3695 and 569. So it's 4264. You adjust your advance tax, which you paid on the discretionary trust, to get your final tax adjustment. So your advance tax on the discretionary trust 14545 minus 8,000, it's 6545, and that gives you a tax refund because you have paid extra tax. Tax receivable minus 4264, so it's 22 81 as a tax refund. So if you look at this question, it's just a quick review of what we have already studied in the previous classes. We already introduced the concept of discretionary trust in the previous class. 45% withholding. You gross it up by dividing it by 55 and multiplying it by 100. Property income is just a normal non-saving income. Dividend goes under the head of dividend. You arrive at total income. You adjust your personal allowance to arrive at the taxable income. And then just the rates of tax. Till 37,700, it's 20%. So obviously 18475 lies within the band. Then 500 at 0%, remaining dividend goes at 8.75%. You get your liability, you adjust your advanced tax to arrive at the final tax value. So I believe it's not difficult. Just a quick review of what we did in the previous class. Now let's move forward and introduce the concept of interest in possession trust, that what interest in possession trust is and how it works. Okay, let's look at that. See, when we talk about this interest in possession trust, it's a bit different type of trust as compared to discretionary trust, but it is a very logical one. The objective of creating interest in possession trust is not to do tax plan. It's a real trust. We are creating it due to our need. It's a real trust which we are creating due to our need. It's not for tax planning. Discretionary trust was for tax planning. We adjust the beneficiaries, do income tax planning. Interest in possession trust is not like that. In interest in possession trust, the donor gives instructions, well-defined instructions in the trust constitution, the rule book, or in his will. The donor gives the instructions that, okay, for example, the donor is old aged, he's about to die. He makes a trust, he gives proper instructions that, okay, the trustees are an employee. The trustees are an employee with limited powers. They have to follow the instructions given by the donor in the constitution or in the will. And the trustees manage the trust and they give income to the beneficiary in a defined manner. Here, the trustee cannot change anything. It's not discretionary trust. It's a well-defined trust. Like, for example, when you are old aged, you won't create discretionary trust. Otherwise, trustee will simply run away with your funds. Because in discretionary trust, the trustees was taking all the decisions. But in interest in possession trust, operates according to the instructions of donor defined in the trust constitution or the will of the donor. Trustees are just an employee of the trust and they have to follow the instructions of the donor defined in the constitution or the will. A real trust. See, trustees are in reality meant to be the employees. They are like the board. They just have to follow the instructions given by the real owner, the donor who gave the assets. Now, in interest in possession trust, you cannot do tax planning. Like you cannot change beneficiaries. You cannot change according to their personal allowances or tax bands. Here, the beneficiaries have defined rights and trustees cannot change them. In discretionary trust, it was all income tax planning. We change the beneficiaries, we look for the beneficiaries in our family. Okay, he has the personal allowance, he has the band available. In this year, he is good. In that year, that person is good. We change the beneficiaries. In discretionary trust, the donor himself becomes the trustee because the entire aim was to do the income tax planning. When you talk about interest in possession trust, it is the real trust. Maybe the donor has died. He is no more alive. Maybe he has died. So his instructions will be followed. Beneficiaries have the defined rights. Now, since in interest in possession trust, the objective is not to do tax planning, the tax rules are also more logical, not like 45% withhold. Income from IIP is taxed on following manner. It's taxed on accrual basis because they have the defined rights. Every year, their income will get accrued and the tax will be charged. Withholding tax will be 20% if trust earns from non-saving or saving sources. What do you mean by this? See, if trust earns from any business, so trading income is the non-saving income. If a trust earns from rental income, so property income is a non-saving income. But if a trust has big bank deposits and trust earns from interest income, so then we'll say that it is earning from saving sources. Similarly, if the trust is earning from dividend source, however, if the trust earns from dividend source, then withholding tax will be 8.75%. In easy words, the withholding tax is the basic rate of tax. In IIP, in discretionary trust, it was the additional rate of tax. In IIP, it's the basic rate of tax. If the trust earns from non-saving sources, so it's 20%, which is the non-saving basic rate. For saving also, the basic rate is 20%. We will study. In dividend, the basic rate is 8.75%. The withholding tax will be the basic rate. For beneficiary, the head of income will depend on the source of income for the trust. Like if the trust earns from non-saving source, for the beneficiary also it's non-saving income. If the trust earns from non-saving sources, for the beneficiary also it's a non-saving income. If the trust earns from saving sources, for the beneficiary also it's a saving income. If the trust earns from dividend sources, for the beneficiary also it will be a dividend source. See, it's logical. Trust earns from non-saving, for beneficiary also it's non-saving. Trust earns from interest income, for the beneficiary also it's an interest income. If the trust has a portfolio of shares and the trust is earning from dividends, so for the beneficiary also it will be a dividend income. Logical, not like discretionary trust that always put in non-saving. Non-saving has the highest tax rate. Non-saving is not the good thing. Non-saving has the highest tax rates. So interest in possession trust, a more logical trust, a more legitimate and a valid thing, not a tax planning tool. Discretionary trust is also permitted. The tax department has allowed it. There is no issue in it. But when we talk about interest in possession, it's a more valid purpose trust in which the instructions of donor are being followed. Trustees are an employee. Beneficiaries have defined rights. Okay? And the donor has created it in real for the benefit of the beneficiaries, not to do tax planning. The beneficiaries can't be changed here. It is taxed on accrual basis. Withholding tax is 20% if the trust earns from non-saving or saving sources. If the trust earns from dividends, non-saving source means trade, property income, things like that. The non-saving column. If the trust earns from interest income, like it has bank deposits, so it will be regarded as a saving source for the beneficiary also. And if the trust earns from dividends, like a portfolio of shares, then for the beneficiary also it will be considered as a dividend income with 8.75% withhold. Let's apply this in 3 practice questions. As you do more and more practice, things will get clear. Let's look at it. Mr. G has following incomes for the year. Employment income 6,500. Income received from discretionary trust 8,000. So there is withholding tax of 45%. Income received from IIP. The question is silent. The question is silent about the source. So when the question is silent, you assume it as non-saving. When the question is silent, it's only written income from IIP. Non-saving, saving, dividend, which source? No issue. When the question is silent, it's non-saving source. And on non-saving source, the withhold is 20%. And the dividend income is 18,000. You have to do the tax payable. I believe it's not difficult. Let's do it. Let's do it. We are making an income tax return. Let's look at it. We are making an income tax return. The first head of income is non-saving. And then the second is dividend. Okay. Here you go. The heads of the income. Employment income, how much? The employment income is 6,500, goes in the head of non-saving. Then comes the discretionary trust. 8,000. 45% is the withhold. So you divide by 55 multiplied by 100. So let's gross it up. Okay. 8,000 divided by 55 multiplied by 100. So it's 14545 goes in the head of non-saving. Then comes the IIP 5,000, 20% withhold, since we are assuming non-saving source, divided by 80 multiplied by 100. So that's 6250 goes in the non-saving head. Then you have the normal dividend income, and that's 18,000 goes in the head of dividend. Here you go. All the incomes are classified in the relevant heads. Discretionary trust is always non-saving. IIP, it can be saving, can be dividend, but since the question was silent, so you put in the non-saving head with 20% withhold. You add up all of them to arrive at the value of total income. So your total income will be 6,500 plus 14545 plus 6250. So that gives you 27295, and here it's 18,000. Done. You adjust your personal allowance 12570 to arrive at the value of taxable income. Okay, so what is your taxable income? Let's look at it. I believe it's just performing the routine steps. 14725, and here it's 18,000. Done. Let's charge tax on it, a routine process. Non-saving income 14725. The basic rate band goes till 37,700. So 14725 simply taxed at 20%. So that gives us 2945. Then you have the dividend income 18,000. First 500 always taxed at 0% in the dividend. If you look at your total taxable income, 14,725 and 18,000, I think it will be around 32,000. So that's whole in the basic rate band. The basic rate band won't be ending. Okay, so the remaining dividend income 17,500 getting taxed at 8.75% because you are in the basic rate band. 17,500 into 8.75%. So it's 1531. I believe it's just something very much basic. You just need to remember the withholdings in order to make the adjustments. Otherwise, it's very easy. Okay. So 1531 plus 2945 plus 1531. So it's 4476 as your tax liability. You adjust your advance tax, the tax credit. There were two tax credits, I believe, in this question. One was for discretionary trust, and other one was for IIP. So let's look at it. Discretionary trust, you gross from 8,000 to 14,545. You can just calculate the difference. I believe it will be 6,545. And here 5,000 to 6,250. It was a gross up adjustment of 1,250. Basically, this grossing up represents the withholding tax impact. So 6,545 and 1,250. So it's a tax refund because we paid greater advance tax. It's a tax receivable of 3319. I believe that it's not difficult. There is nothing difficult in it. Like discretionary trust, 45% withhold, you just need to learn the grossing up. If 45% is withheld, so you gross it up by 55%. IIP 20% withhold, you gross it up by 80%. It's the grossing up which you need to understand. You arrive at the total income, you adjust your allowance, you arrive at taxable income, just the routine steps which you are performing. Okay? And then you do the taxes. 37,700 is the basic rate band. First goes at 20%, then dividend 500, always at 0%. Then 17,500 at 8.75, which is the basic rate, and just the tax credits. So, what is the interest in possession trust? A type of trust in which the instructions of the donor are really valuable. The trustees are an employee. Beneficiaries have the defined rights in the trust. Okay, interest in possession trust. Withhold is 20% for non-saving and saving sources. For dividend source, it's 8.75%. For the beneficiary, the taxation will depend on the fact that from where a trust is earned. Okay, let's apply it in two more practice questions and you will get a more better idea that how exactly you have to deal with the things. Let's look at it. Practice question number 14. Okay, so let's look at this question. Mr. G has following incomes for the year. Trading income 30,000. Income received from discretionary trust. Now on discretionary trust, you all know that withholding tax is 45%. Income received from IIP, earned from dividend source. Now the question has specifically stated that this income was earned from dividend source, so the withholding tax will be 8.75%. If it is non-saving or saving source, then withholding is 20%. If it is a dividend source, then withholding is 8.75%. Income received from real estate investment trust. You all know that on REIT, the withholding is 20% and it goes in non-saving income. And then you have dividend income 11,000. You have to do the tax payable. Again, a routine income tax return. I believe that it's not difficult. Let's look at it. We are doing the income tax return. Okay. Now, you have non-saving income head. You have non-saving, and the other head is dividend income. Okay, here you go, non-saving and dividend. Trading income goes in non-saving simply. Trading income 30,000 goes in non-saving. Okay, then you have discretionary trust 10,000. 45% is withhold. So divided by 55% multiplied by 100%. So you gross it up. Okay. 10,000 divided by 55 multiplied by 100. So it's 18182. That goes in the non-saving income. Then you have interest in possession trust earning from dividend source. So it's 8,000 divided by, now here please listen to me carefully, withhold is 8.75. So what you got will be 91.25%. Think logically. If 8.75 has been deducted, so what you will get, the net amount will be 91.25%. So 8,000 divided by 91.25%. So it's 8767 and it will go in the head of dividend. If it's dividend source for the trust, so the beneficiary will also put it in the dividend. So trading income, discretionary trust, IIP. Then comes the real estate investment trust. It's 6,000 divided by 80% multiplied by 100%. So that gives you 7,500 real estate investment trust. And then the last one is the dividend income, a normal dividend, 11,000. So if you look at it again, see, it's very important that you remember the withholding taxes. These won't be given in the examination. You need to remember these withholding tax percentages. Okay. Now you will arrive at the value of total income. 30,000 is the trading. Then 18,182 the discretionary trust, and 7,500 of real estate investment trust. So it's 55,682. It goes in non-saving, and in dividend it's 19,767. Okay, now you will adjust your personal allowance 12570. 12570, you arrive at the value of taxable income. Okay, here you go. This is your taxable income. It's 19,767 here and 12570. So it's 43112. Done. Now you'll charge tax on it, a routine working. Now your non-saving income is 43112. On first 37,700, you charge 20%, which gives you 7540. Done. And on the remaining non-saving income, it goes in the higher rate band. Once the basic rate band is over, you charge 40%. So that gives 2165. So non-saving income, first 37,700 goes in basic rate band, and then the remaining goes at the higher rate band. Now comes the dividend income, 19,767. First 500 pounds will be taxed at 0%, so that gives you zero tax, and the remaining 19,267. Since the basic rate band is done, so it will be taxed at 33.75%, which is the higher rate of tax for the dividend income. 19,267 into 33.75%, so it's 6,503. Okay, you add them up, you arrive at the value of tax liability. Done. 7540, 2165, and 6503. Here you go. Your tax liability will be 16208. You adjust your advanced tax, your tax credit, to get your final tax payable. So there were three tax credits here. You grossed up 10,000 to 18,182. So that tax credit is 8182. In interest in possession trust, you converted 8,000 to 8767. So that was 767. And in real estate investment trust, you converted 6,000 to 7,500. So that was a tax credit of 1,500. So here you go, you will find out your final tax payable, I believe. So I don't think it's difficult as far as the calculation thing is concerned. 8182, 767, and 1,500. It's 5759. Let me repeat it again. If you look at this question, it was just about looking at the withholding taxes careful. Trading income is a simple non-saving income. Discretionary trust 45% withhold. Divide by 55 multiplied by 100. Interest in possession, dividend source 8.75% withhold. Real estate investment trust 20% withhold. Dividend goes in the head of dividend. You add total income, you adjust the allowance, you get the taxable income, and then simple the tax rates. I believe that you guys are understanding that how you have to deal with it. See, the key is the practice. When you do practice, you will automatically start to learn these things, the withholdings, the format, and everything will start to become easier for you guys. Done? Let's look at one more practice question, one last question in this regard. Okay. If you want, you can pause the recording and try it on your own also so that you can have an illustration that where do you stand. Mr. G has following incomes for the year. Employment income is 22,500, a simple non-saving income. Income received from discretionary trust, the withholding tax will be 45%. Income received from IIP, the question is silent, that from where it was sourced. What was the source of income of the trust? So you assume it as non-saving, the withholding tax will be 20%. Then income received from IIP earned from dividend source. So here the withholding tax will be 8.75%. When the source is stated, you follow that. When there is no source stated, you assume as non-saving. And then there is dividend income 25,000. You have to work out the tax payable. I believe again it's just a routine question following the steps, and that's all. So let's do the tax payable. I want you all to listen to me carefully. So we are making the income tax return. Okay. Two heads of income will be created, non-saving and dividend. Okay, let's look at it. I want you all to listen to me carefully. As you practice, you get more and more clarity, things get clear in your mind. Employment income, it's 22,500. Simply goes in the head of non-saving. Then comes the discretionary trust. 12,000, 45% is the withhold. So you gross it up, divided by 55, multiplied by 100. So that gives you 21,818. Discretionary trust always goes in non-saving income. 45% withhold, you cross it up to 55% because you got 55% in your hand. Then IIP, the question was silent, so we assume it as non-saving source. 14,000 divided by 80% multiplied by 100%. So that is 17,500 in the non-saving hand. Then income from IIP, which is stated to be dividend source, 8.75%. So one more IIP. There are two interest in possession trust he owns. 6,000. 8.75 is the withhold. So 91.25 will be the grossing adjustment. See, it's pretty much logical. If 8.75% has been deducted, think logically. If 8.75% has been deducted, so what you get in your hands is 91.25. 6,000 divided by 91.25. So it's 6,575. And obviously goes in the head of dividend. And then there is normal dividend income 25,000, which goes simply in the dividend category. So here you go. You have classified the incomes in the relevant heads. You have adjusted the withholding tax. I believe that now it's just the simple steps to perform. Just add up, arrive at the total income, adjust the personal allowance, and then do the taxes. The total income 22,500, 21818, and 17,500. All of these were non-saving. 61818, and dividend will be 31575. Done. Adjust the personal allowance 12570. You get your taxable income. Okay, so what's your taxable income? Your taxable income will be 49248, and here it's 31575. Now let's apply the rate of taxes. Non-saving income 49248. First 37,700, always taxed at 20%. So it's 7545. And then the remaining non-saving income will obviously go in the higher rate band. So minus 37,700. It's 11548. Higher rate is 40%, 4619. Okay, so 37,700 at 20% and remaining taxed at 40%. I don't think there's anything difficult in it. Then comes the dividend 31575. 500 will be taxed at 0%. Here you go, that gives you 0. And then the remaining dividend income 31075. Since the basic rate band has already ended, it was used by the non-saving income. So the dividend will now be taxed at 33.75. 33.75, so that's 10488. Here you go. You will get your tax liability. You will adjust your tax credit, the advanced tax, and you'll arrive at your tax payable. So 7545. Okay, just a minute. 37,700 into 20%. It's 7540. A calculation error. Okay, now 7540, 4619, 10488. So it's 22647. You adjust your tax credits from here and you will get your final tax payable. So there were multiple tax credits in this question. Discretionary trust 12,000 to 21818. I believe it's 9818 for the discretionary trust. For IIP 14,000 to 17,500. So it's 3,500. And 6,000 to 6,575. So it's very much clear, it's 575, which was grossed. So 22647 minus 9818 minus 3,500 minus 575. Okay. Always do the calculations yourself also, because sometimes when we are teaching and doing the calculations, there is a risk that we may make a calculation error. So, if you look at this question, again, just a routine one. Discretionary trust 45% withhold, you cross it up by 55% because 45% was already deducted at source. Interest in possession trust, when the question is silent, 20% withhold. When it was stated dividend source, so withhold was 8.75, you grossed it up to 91.25 because 8.75 was already deducted. So obviously what you got was 91.25. You first need to gross it up. You first convert the incomes to full values, calculate the tax, and then adjust the advance tax which has already been paid. You arrive at the value of total income. You adjust your allowances to get the taxable income. And comes the taxes. Basic rate band, remaining non-saving at the higher rate, dividend first 500 at 0%. And since the basic rate band is already over, the dividend income goes at higher rate. Liability, tax credits, and you get the final payable. So if you look at the discussion till now in our today's class, we talked about interest in possession trust. One more category of trust where we are discussing that created for valid reasons, donor giving the asset, defining the instructions in the constitution or the will, trustees are an employee, follow the instruction, beneficiaries have defined rights, it will be taxed on accrual basis, very logical basis of taxation, whatever source the trust is using, that source will be applied on the beneficiary also. Non-saving or saving source, the withhold is 20%, in dividend source, the withhold is 8.75%. And then we applied it in 3 practice questions. I believe that you guys are understanding it. We are constructing the structure, small bricks, step by step. The tax return format, non-saving income, personal allowances, real estate investment trust, dividends, discretionary trust, interest in possession trust. Every topic, its concept, and then the practice questions to give you clarity. Now, in the next class, we'll be moving forward towards the saving income rules, how the interest income is taxed. We'll look at that, and a series of practice questions for that, and so on we will move. I hope that you guys are understanding, and you must have got an idea that how I teach the course. If you have any queries, you can always connect with me directly on my WhatsApp. Okay, so thank you everyone, and hope to see you all in the next class.